Well, g'day there traders and friends, market participants and enthusiasts all around the world. Also, of course, an extended hello to the YouTube community. It is James here with you on behalf of Pivot Point Trading. It has been a little bit of time since the last really public market update. It has been a number of weeks. We were relatively neutral on this market. It didn't really bother us whatsoever which direction the market decided to break. We were in some form of a Bollinger Band squeeze, as you are all well aware. We have broken to the upside and we are continuing very healthy, very structurally sound, I should say, to the upside. Very healthy, very bullish at the moment. Of course, the transition, or at least the beginning of this week again, as at the close on Tuesday being the 14th of February, we are up over 140 points on the Dow Jones Industrial Average. What makes this even more impressive is that we are seeing again continued gaps to the upside. So we are really starting to gallop. We are starting to run. And as you can see on my screen at the moment, we are pushing away from those exponential moving averages. So as you can see on my screen, I've got the 10, the 20, and the 50 exponential moving average. What I want to do in this video is really keep it short, but also, I guess, concise, sharp, and sweet as well. We are obviously bullish both on the macro and the intermediate, also on the minor time frame. We've seen some tremendous profits, not only from exposure to, for instance, Qs trades, diamonds trades, SPYs, whether, of course, you're trading options or whatnot, individual stock or derivatives underlying the stock. We're really seeing, again, the market gain a lot of traction, a lot of grit, and it is just a very nice time. 2017 has been quite a tremendous year to be a trader in the financial markets. It has been a very profitable start to 2017, and I'm just going to run through some of these trades. I mean, not so much the market analysis, but just recap a lot of open positions, which more or less we are in from that Pivot Point Pro analysis class, and how we're sort of following along with this trend, and obviously the trend continuation as it continues to progress. One thing I will point out, obviously, I mean, the markets are in agreement. We are seeing confirmation as per Dow theory, which is fantastic. It has taken quite some time to really establish itself and really give us the green light for this trend to continue. It was relatively, an unstable 2016, but more or less that is in the past at the moment. And as it looks and as it stands and as at the current juncture, I mean, it's up, up, up and away, whether or not you agree with it fundamentally or not. Of course, the markets themselves can be at times kindred spirits. And again, they are driven a lot by just general human psychology and emotion, of course, greed and fear. At the moment, it really tends, or at least it leads towards more so that sort of greed factor or that greed component of sentiment and human emotion at this particular time. You can see on the NASDAQ as well, we had our trigger here at 5,677. This is obviously broken out if you're in the Q trades exposure or have exposure to those Q trades from Pivot Point Pro. You're sitting very healthy. Our original trigger dating back to January was 5,561. So we're looking all right. And going back even to December, I mean, originally it was 5,410. So for the people who've held since December, they are tremendously profitable, not only on those Q trades, but also on the diamond trades as well. You can see these numerous entry points or sort of hypothetical points. This was during the very neutral point in time when we were more so just moving sideways in that sort of low volatility Bollinger Band squeeze where we were looking at the markets relatively neutral. We sort of jumped the gun here at just above 20,000. It took a lot to overcome that 20,000 sort of psychological round number. But obviously, as you can see, we addressed this in Pivot Point Pro. We simply just filled this gap, and the gap which established itself towards the end of January. Let me just bring up the right template for you so you can see this for yourself. Because we hit this, really this nail right on the head. We filled this gap. You can see these low wicks. This is all buying pressure showing up right around this pivot point. It's really just a back test of this macro support, which was developing just below, again, that psychological round number on the Dow Jones Industrial Average. And as you can see, we're gapping and running at the moment. So everything looks okay. We are relatively overbought, but that has been sort of like a current theme really throughout 2016, and it is obviously continuing into 2017. We still have some very big macro areas of divergence which you should pay attention to. I mean, I've addressed them in the past, both on the weekly and the monthly time frames. They're still, I mean, some are starting to break down more so on the weekly time frames, but those monthly time frames, if I can just quickly show you them, you can see for yourself as price continues to really continue high. You can see that we're still not getting the confirmation across the board on the MACD. We're starting to sort of break above it on the stochastics, but when we speak about and reference and really just, I guess, talk about MACD or divergence itself, pardon me, it really applies to like the actual MACD indicator itself. So continuing on from this discussion, if you really hold on throughout the entirety of this Tuesday afternoon market recap, I'm going to show you one pretty interesting piece of analysis. But before we get through that, let's just have a look at some of these stocks which we've been speaking about and sort of following through with in that Pivot Point Pro analysis class. First of all, we're in Apple at 131.45. That's continuing to the upside. We've got a secondary trigger here At 133.96, we got very close to actually hitting that or triggering that. We haven't, well, not in the second portion, I should say, pyramid of the actual trade at the moment, but that is reflecting very, very healthy. Boeing Airlines, again, is just triggered above 167.29. Again, we did the gap fill and we got the breakout at 161. Got awfully close to our first target, but we have definitively hit the target on Boeing Airlines, and that has a lot of potential to actually run. One of my most proudest trades, really, in terms of analysis and just structure, that we've been following very, very closely for a number of weeks and months, as this is really set up very nicely, was Baidu. As you can see, I'm not sure, I might have to zoom in on my screen so you can see this. Well, this was going back to the beginning of January. We had this original 172 entry. We hit our 181 target in a matter of days. We did the pullback, the 123 back test, and then we've had two secondary entries. One at 177.55. The second entry has been at 179.27. They have obviously both triggered to the upside. They are both bullish and very, very profitable if you are trading those underlying derivative contracts as well on the core sides, obviously. So that's very tremendous. It's a great trade at the moment. Our target on this trade is 190, or just shy of it. You can see for yourself, 189.62. We actually have a third entry at 184.59. I sat this one out, obviously, because I've got two open positions on Baidu personally. But just another fantastic trade, which is really establishing, or at least, helping out the beginning of 2017. And it really is turning into a very profitable start to the 2017 trading year. On top of that, look at this, Caterpillar. This week on Monday, 96.14, we hit our target today, 98.57. We've got an additional re-entry at 99.52. These, first of all, this is purely educational. I'm not here on YouTube to be, soliciting any advice whatsoever to you. This is my own personal trading, analysis and how I apply it to the financial markets. But look, I wouldn't be sitting here if you're uneducated or uninformed in the market and you're not well versed in technical analysis to really be using this as a cheat sheet, so to speak. It's more so just sharing with you some of the trade opportunities which, we're looking at in Pivot Point Pro each and every Saturday when I sit down and do this recording. We don't have any action at the moment in ConocoPhillips, nor do we have any action at the moment in Chevron Renaissance, nor Google. Goldman Sachs is quite interesting. It has been tremendously profitable for people who caught the breakout, and again, that's due to a lot of some of the new policies or sort of rhetoric around, again, sort of the deregulation of the financial sector. Whether or not that actually, obviously it's going to happen, but it's a little bit unclear and a little bit uncertain, a little bit vague, but a lot of the financials obviously have progressed, or at least strengthened very healthily towards the end of 2016. They have sort of stagnated, but that is due obviously to just how overbought and overextended they were towards the end of 2016. It has sort of stabilized. It is holding relatively stable at the moment, and this really sits firm for a lot of the financials as well. But Goldman Sachs is on the precipice of breaking out, which is quite interesting. IBM again is just taken off. Look at these two triggers. This was going back to mid-January, 170.48, 171. Hit our first target obviously in one day, but we just galloped, and yesterday we hit our secondary target at 178.68. So again, that's like another $8 or $9 with those derivative contracts as well. So it really is a pleasant time to be a technical trader. Tesla also last night, or yesterday I should say, today really broke out above 273.07, and this is something that we spoke about in class over the weekend, the potential for this to really gallop. And I'm using the term gallop because there's a lot of open air, there's a lot of potential for this to really get moving. And as you can see, I've got this target on my screen for yourself, as you can see right here at 283.75. So today alone it was up $11.37. Again, original entry 237.07. We closed it above 280. So that's another $7.70 odd cents or so on my screen as well. So that's a very quick recap of individual stocks. One piece of analysis, and again, this isn't to blindside anyone whatsoever. This is just me trying to be as neutral as I can possibly be with technical charts, and just to alert people to certain things when I see them from time to time, because it's very important that you just understand what type of market we're in and how we're sort of, following the trend at the moment. Obviously, we're trending bullish. Everything is healthy, other than, of course, those macro divergent signals setting up across all three of the widely followed US markets. Of course, the Nasdaq, the Dow, and the S&P 500. But one really interesting and intriguing piece of information that I'm personally looking at myself as sort of, a potential sort of slowdown area are some of these past trend lines where we've seen, previous cycles begin and also end. If you go all the way back to the beginning of the run-up where we peaked in the year 2000, before the dot-com bubble, and of course where we bottomed towards 2002, 2003, And then, of course, the next bull market cycle up to the peak in 2007 and then the low in 2009. You can see these two particular lines, and this is very, very important. It is applicable to the S&P 500, not so much the other two markets, but in the past, and if you apply this to, of course, 2007 and then where we are at the current juncture, we're starting to see, I guess, what I call in terms of technical analysis, X marks the spot. Now, I'm drawing an X on my screen. Not to say that this is incorrect whatsoever, but it's just a piece of analysis. We sort of use the word or the term confluence in other areas of technical analysis. But if you pay close attention to what I'm looking at, again, I'm just going to highlight this for you. You can see this extension. This is what we call a trend line, and these red lines here are what we project out into the future to see, or at least to give us, expectations of potential resistance or even support if it is, bearish trend lines. So as I go into the nitty gritty, and if I zoom on into the current juncture, everyone's really celebrating, of course, the S&P 500. Here we are. We've cleared above and we've closed above and we've continued above that 2,300 area, which is fantastic. Everyone's applauding. Everyone's, caught up in the bull market, which is fantastic. But these two lines, this is on the weekly chart. I mean, it was on the weekly chart, but now it's on the daily chart. This has been extended out, and we're sort of getting this figure at the moment. I mean, this is somewhat, it's as close as really as what you can get in terms of technical analysis. It is a little bit of a sort of a gray scale instead of just a simple black or right or wrong type of answer, but you're getting this rough sort of figure here around 2,336. And I was explaining this and sort of talking to people in that pro class over the past number of weeks about the potential of a slowdown around this area. So as this market continues to run, personally, and this is just me, just personally, I'm looking at 2,336 as a potential slowdown. I'm not talking about a reversal at this particular point. We have no candlesticks. There's no real chart patterns at this point to suggest anything otherwise. But we may see the market itself sort of move sideways for an extended period of time, very similar to what we saw in January, in February, before this recent breakout, which is going to maybe surprise a few people. But again, it really shouldn't surprise you if you do begin to see this. The first thing you want to be looking for are candlesticks. And then, of course, if I go to some of these oscillating indicators, you're going to see that naturally they have to reset. Obviously, we're very broad across the board on the Stokes, on the RSI, on the MACD, and also when I bring up some of these other trend following indicators. I mean, the ADX isn't as extended as what it has been, but again, the CCI has been sort of in this, or at least, pushing above positive 100 for quite some time, which of course supports the bullish trend. However, having said that, I mean, eventually and inevitably it is going to have to crack the 100 or the positive 100, which generally means that we are moving into a sideways type of phase in the markets as well. So again, you just need to keep, I guess, your emotion under control and just be, I guess, rational and logical when you look at these financial markets. It has been a tremendously profitable start to 2017, and again, I hope it continues. I'm sure it will. As long as the market's moving, we should be okay and we will be happy. Addressing these markets and looking at market analysis and looking at potential trade setups. What we don't want is just highly volatile markets, which are sort of moving backwards and forth in a really unpredictable, sort of uncertain type of trading manner. That's never really friendly for anyone other than, of course, day traders. What we do, we're swing traders. We look at these markets more so on a daily time frame towards a multi-week type of time frame, out to more so a couple of months, given, of course, the current juncture of the market at the moment, given that we are trending. And I mean, we've got a lot of exposure to the overall market indices through the Qs or the diamonds or the SPYs, depending on what you're actually in at the moment, that we're sort of pushing out even out to May, those types of dates at the moment, just because we're happy to hold them indefinitely just to see how far this really runs. But again, just to recap, the S&P 500, it is quite an interesting level. It is quite an interesting figure as well. And it's something that you should pay attention to, I believe, moving forward as we round out February and move into March as well. So on that note, everyone, I hope that was as, I guess, precise, as short, as sweet, as sharp as it could possibly be. There was a little bit to talk about. I feel as though I was obviously recapping a lot of individual trades. But again, these things take time in the markets. You cannot really force trades. The best trades come when the market is ready to move. And of course, you sort of sit here waiting, being disciplined and being patient in your approach to actually getting into positions that you should feel comfortable with. And of course, as much motion or emotion, human emotion, should be taken out of the trade before you're even in it. And it's something very interesting to study and to think about and to practice, and obviously apply to the financial markets if you want to do this full time or to become obviously long-term profitable in the financial markets as well. So on that note, everybody, I'd like to thank you for your time, for your participation. If you'd like to learn more, I would encourage you to have a look at Pivot Point Pro. Other than that, enjoy your evening. It may be a morning where you are around the world. It may be, of course, a Wednesday morning pre-market update. It might even be a Wednesday afternoon market update by the time you actually see this video. But it is very applicable. It is very pertinent. And I'm appreciative, pardon me, that you are listening to it and you do find, I guess, satisfaction and some amount of, I guess, education and something from it as I do look at these markets for you in this public forum here on YouTube. All the best, everyone. It is James signing off on behalf of Pivot Point Trading. All the best. Farewell.